Chapter 3: The Changing Value of Money. The real economy and the financial economy each has its own supply and demand dynamics. In this section we will focus more on the supply and demand dynamics of the financial economy to explore what determines the value of money. Printing and devaluing money is the easiest way out of a debt crisis. While people tend to think that a currency is pretty much a permanent thing and believe that cash is the safe asset to hold, that's not true because all currencies devalue or die, and when they do, cash and bonds, which are promises to receive currency, are devalued or wiped out. That is because printing a lot of currency and devaluing debt is the most expedient way of reducing or wiping out debt burdens. There are 4 levers that policy makers can pull to bring debt and debt service levels down relative to the income and cash flow levels that are required to service one's debts. Austerity, spending less. Debt defaults and restructurings. Transfers of money and credit from those who have more than they need to those who have less than they need, for example, raise taxes. Printing money and devaluing it. In comparison to the others, printing money is the most expedient, least well understood, and most common big way of restructuring debts. In fact, it seems good rather than bad to most people because it helps to relieve debt squeezes. It's tough to identify any harmed parties that the wealth was taken away from to provide this financial wealth. You are seeing these things happen now in response to the announcements of the sending out of large amounts of money and credit by central governments and central banks. Most people don't pay enough attention to their currency risks. Most worry about whether their assets are going up or down in value. They rarely worry about whether their currency is going up or down. Think about it. Right now, how worried are you about your currency declining relative to how worried you are about how your stocks or your other assets are doing? All currencies have been devalued or died. Of the roughly 750 currencies that have existed since 1700, only about 20% remain, and of those that remain, all have been devalued. While the dollar, pound, and Swiss franc existed back then, most others were different and have since died. In 1850, in what is now Germany, you would have used the gulden or the thaler. There was no yen, so in Japan you might have used a koban or the ryo instead. In Italy you would have used one or more of the 6 possible currencies. What do they devalue against? The most important thing for currencies to devalue against is debt. That is because the goal of printing money is to reduce debt burdens. Debt is a promise to deliver money, so giving more money to those who need it lessens the debt burden. Increases in the supply of money and credit both reduce the value of money and credit, which hurts holders of it, and relieve debt burdens. In cases in which the debt relief facilitates the flows of this money and credit into productivity and profits for companies, rising real stock prices, i.e., the value of stocks after adjusting for inflation, happens. When it sufficiently hurts the actual and prospective returns of cash and debt assets so that it drives flows out of these assets and into inflation hedge assets and other currencies, that leads to a self-reinforcing decline in the value of money. To do that, I will show you the value of currencies in relation to both gold and consumer price index weighted baskets of goods and services, because gold has been the timeless and universal alternative currency, and because money is meant to buy goods and services, so its buying power is of paramount importance. I will also touch on their value in relation to other currencies or debt and in relation to stocks, because they too can be storeholds of wealth. In relation to gold. The chart below shows spot currency returns of the 3 major reserve currencies in relation to gold since 1600. While we will examine these in depth in this study, for now I would like to focus your attention on both the spot currency returns and the total returns of holding interest-earning cash in all the major currencies since 1850. The value of currencies in relation to goods and services. Thus far we have looked at the market values of currencies in relation to the market value of gold. That raises the question about how much of this picture is because we are looking at the value of currencies relative to gold and whether that is an appropriate gauge. The next chart shows the value of interest rate earning cash currency in terms of the CPI baskets of goods and services in these currencies, so it shows changes in buying power. In other words, history has shown that there are very large risks in holding interest earning cash currency as a storehold of wealth, especially late in debt cycles. The patterns of countries devaluing and losing their reserve currency status. Currencies devaluing and currencies losing their reserve currency position aren't necessarily the same things, though they are caused by the same things: debt crises, and a currency losing its reserve currency status comes from chronic and large devaluations. What do these devaluations have in common? In the major cases we looked at, all of the economies experienced a classic run dynamic, as there were more claims on the central banks than there was hard currency available to satisfy the claims on that money, which was typically gold. Net central bank reserves start falling prior to the actual devaluation, in some cases starting years ahead of the devaluation. The run on the currency and the devaluations typically came alongside significant debt problems, often related to wartime spending, which put pressure on the central bank to print. Typically, central banks respond initially by not increasing the supply of money, so that when their currency and debt are being sold they let short-term rates rise to forestall the devaluation, but that is too economically painful, so they quickly capitulate and devalue. After devaluation, the outcomes diverge significantly across the cases, with a key variable being how much economic and military power the country retained at the time of the devaluation, which impacted how willing savers were to continue holding their money there. End of Chapter 3.